We're carrying on with this discussion on 2012 fund reviews and performances that we saw. And David, let's just throw forward to the foreign equity space, because looking at the performance on that end, it's also once again an African fund that stood out. This time the Prescient Africa Equity Fund with their one-year return there of 50.1%. So what did you see when it came to best foreign equity performance last year?
Yeah, so again, you've got a bit of on the foreign equity category could probably be defined and grouped a little bit better. So, what you're seeing here are the two top funds. Global is being defined as sort of anything outside of South Africa, and so one is specifically focused on Africa, which would have a very different risk return profile from a fund, let's say, focused on Europe, Asia, the developed markets or first world markets. And then the second place fund there is a global financials fund. So again, focused on just one sector of the market. So, anytime you get a very concentrated group of funds can be compared to a more diversified set of funds, any one of those concentrated funds, if they happen to be investing in a sector or a subset of the market has a good year, they're going to rise to the top or the bottom of the charts. And that's, I think, a little bit what we're seeing here.
It's almost like Prescient got their strategy right and Stanlib didn't when it comes to Africa, if you look at the worst performance.
Yes, I mean, it's
sure, yeah, and I think that's a great point.
I mean, it's interesting for me because, I mean, here you've got same universe, same opportunities, but you've got two funds with just divergent and completely divergent type returns, which shows you that philosophy and process and portfolio construction and how that relates to both philosophy and process, both of those become really, really important in order to drive returns going forward. Let's maybe just quickly show you what those look like. So these are best foreign equity funds. There you can see the Prescient Africa Equity Fund right at the top with a whopper of a return at 50.1%. Adrian van Niekerk and Jonathan Kruger runs that fund, and then right below it is the Sim Global Financial Fund. Now that'll be no stranger to you. That's obviously the fund run by Koki Koeman, a man which won the Fund Manager of the Year award last year. How does that compare to worst? Well, there you can see it. Right at the top there, you can see the Stand-Up Africa Equity Fund. The 10.2% return, and let's not stare at that. I mean, a 10.2% return is nothing wrong with that. And then followed there, obviously, by the PSG Global Equity Fund at 10.8%.
Yeah. Should we move on to the?
I think the other thing that's worth.
Yeah, David.
I was going to say the other thing I think that's worth pointing out is that the difference between the returns of the two Africa funds, it tells you a lot about the volatility and the risk return profile of the asset class. I mean, you just wouldn't see that type of divergence between two domestic fixed income funds, or to be honest with you, probably even two U.S. equity funds. I mean, you could, but it'd be far less unlikely. So not only does it tell you the difference in the managers and their selection, but also the opportunity set within that asset class.
Just before we actually move on to fixed income space, perhaps worth spending a bit of time talking about foreign equities this year. What are your thoughts as to direction, where to invest, developed versus developing world?
Well, I think we're seeing in the last few months certainly a recovery in the news flow from or the economic and fundamental revisions to earnings in Europe and in the US. I think we had that bit of a fiscal cliff concern that is sort of still looming over us. But certainly European markets are still very much in favor. And I think EM markets are just taking a bit of a backseat in the last few months. They've had a fantastic run in the last year. And I think if we can get something similar from these returns again this year from South Africa, I think it would be quite unlikely. Probably should normalize to much more median kind of returns or average returns, which these are way above.
Just looking at the returns in the equity space, you certainly weren't getting that double-digit returns in the fixed income space.
No, absolutely not. As a matter of fact, let's look at some of those returns. Have a look at the domestic fixed income funds. Right at the top is the Momentum Maximum Income Fund. It's a fund run by Conrad Wood, a guy that's been in the industry for probably close to 20 years now. And Chief Investment Officer on the fixed income side for Momentum. And that's followed by the Investment Solutions Income Fund at 8%. Now, the interesting thing for me is you can see both Net Group and Standard Bank there with their Fundisa options. That obviously is a joint venture between government and the unit trust industry trying to get people to save for education, which obviously is a priority for the National Development Plan, which has gone kind of front burner again as far as policy is concerned. Let me show you worst domestic fixed income. And there you can see what some of those look like. Investec Steffi Plus at the top and Standard Enhanced Yield. I mean, these, again, I say what David said just now. The actual divergence between, kind of top and bottom is much slower because obviously you've dialed back the risk completely and you're in the fixed income category.
Yeah, worst performers all still above 5%. And as you say, the difference between best and worst is very minimal when it comes to last
A single
year.
decision that you make during the year could make you end up at the bottom or at the top. It's that tight in terms of relative performance.
Yeah. What stood out for you, David, on the fixed income front in 2012?
Yeah, I mean, number one, that they're very, very high returns for fixed income. In the developed world and in U.S. and Europe, I mean, you're looking at very close to negative real interest rates, and so even your long-term fixed income funds are you may be getting sort of 2-3%. So that looks pretty fantastic from a risk return perspective. That said, there'd be a different risk return profile with fixed income in South Africa than the developed world. That's the perception anyway. Whether there's actually more risk or not is a different question, probably worthy of a long debate.
Yeah, certainly another 60-minute debate we could have, or perhaps even a day debate on where the real risk lies in the world right now. Small and mid-cap equities, I mean, also a stellar year. And in fact, I think it was just looking at the indices, I think the indices outshone even the Aussie return last year.
Yeah, and again, I mean, that's again that kind of passive versus active debate, and should you really be active and should you really be passive and so on. I mean, indices did very well because the index did well during the year. But there are those fund managers, again, that have done better. Again, I always say the choice to be active or passive comes down to philosophy and if you actually buy what the fund manager is trying to do for you. Let's just quickly look at mid and small caps. Remember that this category obviously hangs right at the bottom of the top 40, and they're recipients, obviously fast-growing businesses and recipients of capital once the top 40 kind of starts filling up. And there you can see some of the returns from that category. The Investec Emerging Companies Fund, that's run by Richard Middleton at 40%. You can see that's an absolutely fantastic return. Richard having run previously the Stand-Up Growth Fund, and then below it, this should be no stranger to you, the Net Group Investment Entrepreneur Fund at 39.4. That's obviously an ABAX fund. I mean, the interesting thing is, look at the magnitude of the returns. I mean, absolutely fantastic returns that we're seeing from this category. I'm hoping that when we kind of go and we look at the end of this year, that we'll start seeing some more resource funds kind of coming back into the foray, especially seeing all the bad news that we're seing in that sector at this stage.
I'm sure that will be the case. Just very lastly, financial funds last year. I mean, the financial sector really came to the fore last year, and we're still seeing buying on that end. But fund-wise, Net Group stood out.
Yeah, again, I mean, look at what those rankings look like on your screen there. There you can see Net Group Investment Financials right at the top there, 39.2, and then obviously no stranger to you should be the Coronation Financials Fund at 35.9. And any of those returns kind of stand out as fantastic returns. So financials certainly definitely did shine during the last 12 months.
Don't forget that the financial indexed at 38% for the year as well. So there are a few funds, but only 2 that have beaten the index in that category.
Yeah, and that brings me to a very quick point I want to make, is that the 2 best performers last year were index tracking funds, the ETFs, and one of them being the Satrix ND. David, where do you stand right now when it comes to the whole debate around passive versus active? And yet it is another 60-minute debate we could have. But I mean, fund managers last year spending so much time scrutinizing the market, making decisions, following their instinct, and perhaps not always getting it right. And then, of course, you could put your money into ETFs and just have tracked the market and done just as well.
Yeah, I object to the whole debate. I mean, the framing of the question, active versus passive, I think is unfair and unproductive. I think that investors should open their mind to both approaches. And for example, for myself, if I'm looking at a category and I want to make an investment, let's say I want South African domestic equities, I'll look to the active space, and if I don't find an investment option that is worthwhile, then I'll revert to the low-fee index tracking ETF or mutual or unit trust. So I don't understand where it was ever written that you had to choose one or the other, or you had to take a side on this issue. There are certain managers that have demonstrated an uncanny ability to outperform over the long haul. And why wouldn't you, play the odds? And if they've shown an ability to repeat that performance, for me, I'll take my chances there. And when I can't find that, then I'm happy to buy an index fund or an ETF.
Do you agree with that?
Yeah, I mean, what is interesting in 2012, if you look at what David just said in the broad categories, the domestic general equity fund, the managers in there actually significantly, on average, outperformed the market. So clearly that's where the skill was in 2012, whereas in the financial and industrial categories, they significantly underperformed the market or those relevant indices. So different sectors in different years have more opportunity for managers to add value than in others. So in some sectors, passive might have worked better, and others, active might have worked better. So it's a bit of a mix and match problem.
Yeah.
And I'll say what a fund manager said to me the other day. He said, alas, 12 months is in the bag. If you were right, fantastic. And if you were wrong, that's not so fantastic. But there's one problem. The next 12 months is looming. And what will win then?
And perhaps I'm sure we'll have discussions around what to expect from 2013. And looking forward to having you on the show, David, after the Q1 figures come through for fund managers, seeing what we're seeing so far from the year. But thanks so much for joining us today.
Sounds good.